Markets expect a slow, cautious rate cut cycle. The biggest risk is a hawkish tilt, and they can delay cuts, which we're already pretty sure is going to happen. If the Fed minutes hinted a cut as soon as March or May, the markets will rally. If they push back the cuts, markets will sell off sharply. But again, we've already sort of incorporated this stuff. So, let's take this. Why can I not cut this? What's going on? Oh, interesting. That stuff is below the line. Huh? I did not mean to do that. I'm very upset. Bodhi. Okay. Here is Warren. Yeah. Whoops. So now I'm basically just showing Bodhi what Warren said. And this session of Bodhi was started last week. That's why I'm not sure he knows who Warren is. All right, and that should give us a pretty good idea of what's going on. One would hope. Let's see, go to PhilStockWorld. And I am not logged in properly. Come on, man. There we go. Now we have full access. Jean-Philippe likes the education post. Thank you. We are going to be updating all of our education posts actually and adding more. That's the easiest one on trade, 2 on trader status, turning short-term trades into long-term trades. So on the weekends, you'll see these. And hopefully I can get 2 to 4 done on each weekend until we have more caught up. If you have any requests, feel free to say so during chat. If you want a certain education post, you can always customize them. Let's see, where were we? Bodhi. Come on, man, what's going on? Oh, he's still writing. Look at this. Hawkish shift lightly. Fed likely to push back against March cut expectations. Emphasis inflation risk, more concern about the combination of hot January inflation data and new tariff proposals suggests the Fed minutes will lean more to the hawkish than Warren's original analysis predicted, and with particular emphasis on, hello, they stuck? Seems stuck. They've been having that problem lately. He's just gotten too much. He's gotten too smart for the program, and he's busting the limits. So CPI came in hot. Core CPI, PPI, SPY trading volume declined significantly. Markets showing increasing volatility. Trump's new tariff proposals are affecting sentiment. See, he's got the live connections. Let me just refresh that. Hopefully that'll help. Or to lose the whole thing that we talked about. One of the two. Whoa, dude. The hell? That's a new one. Oh, I see. That's Warren's thing. Oh, there we go. Great. That was Warren's text came in. So, Trump's new tariffs affecting sentiment, revised expectations. March cut now appears unlikely given hot inflation data. Market expectations shifting towards May and June. For first cut, total 205 cuts remain. Likely reduced to 50. He's still 50. Well, the minutes will likely emphasize persistent inflation, the impact of new tariffs. Hawkish shift likely. The Fed likely to push back against March cut expectations, a greater emphasis on rate. The combination of hot January inflation data and new tariff proposals suggests the Fed minutes will lean more hawkish than Warren's original predicted, with particular emphasis on upside inflation risks and international financial stability. The bull case has shifted from neutral to hawkish leaning neutral, with markets, okay, great. So let's copy that, give that back to Warren. Don't forget the minutes were as of the last meeting, so it's up to you to parse out the intervening data. Here's Bodie's update for you. So here's Bodie's update for you, but keep in mind the Fed minutes are only up to their last meeting. Okay. Now, back to Bodie. I don't know if he has a particular answer for that, but we'll see. Oh, he's only just working on it. Man, he's like crashingly slow. Whoop, there it goes. Based on the latest data, here's an updated Warren's analysis. Oh, no, here's where we're still working on down here. Craziness. All right, so. Well, I got to get this done so I can get it off my head, otherwise I'm going to keep thinking about it. But how long will he take? Oh, man. All right, anyway, so we've been working on our portfolio reviews, and We're also looking at earnings from various companies, but I don't think we're gonna have time for that because it's already 1:18. So let's talk about the portfolio reviews because that's always good to look at. And hang on a second. All right. So yeah, long-term and short-term portfolio of $4 million already. So that's pretty damn good. And probably that's where they were last month. So we'll see where they are this month. I won't know until I'm finished reviewing the long-term portfolio because I have to make sure everything is updated and that we caught all the new entries and blah, blah, blah. It's a real pain in the ass. Let's go back very far to see if anything was missed. But anyway, so the S&P overall in the last month was up 4.7%. Pretty much about 5% now that we're testing the all-time highs. And the question is the rally done or does it have more legs to go? The RSI is only at 58.6, so it doesn't get stressed out until 70, so that has more room to run. The MACD is also not up at this line, so it's still got more room to run. We have this very, very steadily like a rock rising 200-day moving average, and the 50-day moving average is popping over that all-time high. So, you know, we may not hit any real resistance until 5,800, and that's going to take at least this long, which is a good month. So it's going to take a month or a month and a half before we even test proper resistance at this point. So this thing could run up for another month and a half. Let's say it goes along this line, and we could be somewhere around, well, it's not far. I mean, we could be somewhere around whatever that line is. If that's 60.50 and that's 61, that's 61.50. So 61.50, 62 is what we can expect going forward. Oh, come on, Bodie. Gave you enough time. I hope I gave him enough time. Okay, great. So now, shit. Don't forget the minutes after the last meeting. Okay, no, this is right. So CPI, PPI, I thought I saw this before. China's Banky rescue package, property crisis developing, the yuan. Okay, yeah, he's adding in some more stuff. March cut dropped to near zero, total 2025 cuts, now priced in at 042 from 75, so not really two cuts. First cut delayed until May or June, Treasury yields, dollar strengthening. The minutes will reflect, bold predictions. The minutes will reflect a Fed that was already cautious in January, but subsequent data has made their stance even more justified. Inflation readings suggest disinflation progress is stalled. China's property crisis poses increased global risk. China's new tariff proposals Trump's new tariff proposals, additional inflation uncertainty. Okay, great. So that's what I wanted him to add. Now I give all this to Warren to chew on. And we'll see what Warren has to say about that. See, now let's synthesize everything we know. The December meeting already hinted a slow pace of cuts. Given the hot January inflation data, the Fed is unlikely to have signaled an imminent March cut. At best, minutes will indicate a cautious approach to rate reductions, likely pushing the cut into May or June. January CPI and core CPI readings post date the meeting. but the December minutes already warned that disinflation was slowing. The minutes will likely reveal that the Fed was already worried about the sticky services, which aligns with January's numbers. Add in Trump's new tariff proposal, we now have added upside inflation risk. The January Beige Book showed continued hiring while layoffs remained rare. Wage growth picked up moderately, which aligns with recent inflationary pressure. And the Fed's primary concern is likely not mass layoffs, but wage-driven inflation, which keeps services inflation elevated. The S&P is an all-time high, fueled by AI and big tech. Treasury yields have now risen to 4.45, suggesting the markets are adjusting rate cut. If the minutes flag financial conditions as too loose, expect hawkish pushback against premature rate cuts. China property crisis, Fed minutes will not reflect the latest Vanke rescue package or property distress, but they acknowledge the risks. If they flag China's slowdown and global risk, it could temper their hawkish tone. Okay, this is nice. Update. It's a good report. Updated market and policy implications. Rate cut timing. March, May possible, May, June more likely. 2025 rate cut, 75, now 42 to 50 expected. Inflation, sticky but easing, hotter than expected CPI and PPI. Labor market, oh, I see some of the December Fed minutes. Solid softening gradually, still strong wage pressures up. This is all heading the wrong way. Financial conditions loosening, but the Fed is watching. Too loose, stock markets are frothy. China risk, no major concern yet, is worsening. The Fed has to acknowledge it. Tariff and trade, possible upside risk, continued inflation risk. Based on what we expect from the Fed minutes, if the minutes are more hawkish than expected, stocks will sell off, Treasury yields rise, dollar strengthens. If the minutes are neutral but acknowledge concerns, slight pullback, while long-term long end may hold, markets may cut pricing, but reduces odds of more cuts. If the minutes are unexpectedly dovish, then stocks can rally. That's unlikely. But if they emphasize China's slowdown, the markets may react bullishly. Final takeaway. I don't expect any mention of China from the Fed minutes. They weren't thinking about it at the time. Final takeaway. They should have been. You know, we think about China all the time. But I don't think the Fed does. Final takeaway, March cut off the table. 2025 rate cuts, not very likely to have more than one, well, more certainly not more than two. Hawkish tilt, very likely, especially with new inflation risk, biggest unknown, how the Fed assesses China. It'll be 2 p.m. I'll be here at 2 p.m. to break down the minutes. Expect a shakeup, and then blah, blah, blah with questions. Okay, great. All right, now we can get back to this. So, you know, we do have room to rally. Here's what the heat map looks like. This is for the past month. Apple had a nice run, 7.5%. Nobody had a run like Facebook, which is up 20% in a month. Walmart had a nice run, though, up 14%. Costco up 16%. Coca-Cola 10%. Oh, actually, Philip Morris 25% gain. So basically, since the election, these guys have done great. Mondelez had a nice move. P&G, only Pepsi's lagging. Pepsi's lagging badly. Here's T-Mobile up 26%. AT&T up 17%. Netflix up 26%. So telecom and entertainment was a place to be, man. Everybody went up. Tesla dropped 13%. That's pretty shameful, right? Nike with a little bit of a comeback, up 3%. Starbucks up 20% in a month. McDonald's up 10%. Booking is Priceline, they're up a bit. Who else was significant? Nvidia made 5%, which is a lot considering where they are. IBM 17% gain in a month. That is intense. Uber up 16%. It's massive numbers here. JP Morgan 10%, Visa 10%, MasterCard 10%. So the financials were a good place to be. Goldman 9%, not 10%. Lilly 12%. AbbVie, so Pfizer not catching a bid, Merck not catching a bid. With our mega farmers didn't do it, but Lilly and AbbVie and J&J did good. Abbott, Boston Scientific, United Health, ISRG. That's probably not a very exciting move, like a few percent. Exxon was down. In fact, almost the entire energy sector was down. Basic materials, so-so. The smaller basic materials, not as good. Utilities, pretty good for the most part. A few misses. And don't forget, some of these misses are specifically because they had bad earnings. That's a whole different thing you want to check out when you see, like, why did they underperform the group? Well, maybe their earnings came out and they weren't so great. But that's it. But on the whole, I mean, there's a sea of green in here. Generally, things are pretty good. In fact, the reds are pretty concentrated in a few places like asset management and energy. And isn't it weird that asset management does poorly when all the assets are doing well? But so energy, asset management, diagnostics didn't do well, materials not so great. Farming was not the best place to be. Aerospace had problems. Lockheed Martin with a big drop. So that's where we are there. And in the short-term portfolio, we looked at all, well, let's look down here. I'll tell you what it is. So DHI, earnings were good on DHI, and you can see that here, right? So earnings were actually good, but they're down with the real estate sector, which is getting completely beaten up because their peers, like Toll Brothers yesterday, are doing terrible. And not only that, though, but the overall housing numbers are terrible. But one thing you have to understand about when you look at housing starts, it's heavily influenced by multifamily housing. So if they're holding back on building buildings, apartment buildings and stuff, that's going to really impact housing starts. Some of that is a weather factor. Some of it is a labor factor. We're running out of laborers. It's not going to necessarily affect a small builder. Not small, but I mean, you know, somebody like DHI, they're developing their own stuff. Hovnavian's another one. They're developing their own land. They've had this land and they steadily develop it. It's their own crews and their own people. They're not like scrambling and running out and doing one-time projects. They've got people who always work for them and are always there and are always turning over a percentage of their building. So we like DHI despite the struggle. They were at 130.57 here. Now they're at 125.71. So they dropped $5. And that's because Toll, this just happened yesterday, that's because Toll was horrific. So Toll dropped like $10. And they had bad earnings, bad outlook, bad everything. And Toll is like DHI. So you look at Toll Brothers and say, well, if Toll Brothers is doing badly, then DHI must be doing badly. But that's not always the case. One builder can have a better plan than another one. One builder can face certain issues that another one's not building. First of all, Toll Brothers is a very northeast builder, so they got hit really, really hard with the storms. DHI is not that much in the northeast, so they have different conditions and so on and so forth. You know, you have to look a lot closer than just a few surface details to figure out what's happening with these guys. And so, even so, totally, I mean, all the builders are a good deal. They've been so beaten up; they're generally a good deal at the moment. And so what did we do with this one? We had in the short-term portfolio, we only had the short calls, the short puts on DHI. So we sold the 145 puts for $11, almost $12. So that's 133. Yeah, 133. So we're netting in for like 133. And the stock is at 133 or 130. So it's not like we're badly down. And so what do? We just sent it to the long-term portfolio. And how does that work? The long-term portfolio gives the short-term portfolio $23,000 to wipe that out, and it picks up the short calls, but now it picks them up at it's 10, so it picks them up for $23.20 per put. It pays $23.20 per put, which is the current price of the puts. So it's a way that we transfer money from the long-term portfolio to the short-term portfolio, giving more money to our hedging portfolio. Meanwhile, the LTP picks up the short puts for higher cost, so it has a higher basis and it spends it, but that's okay because then we're adding all this other crap to it and turning it into a full play. All right, we're just starting out $11,000 behind from where we started in the short-term portfolio. But the long-term portfolio is sitting on like $1 million in cash, so it can easily afford to spend $23,000 for the puts. Meanwhile, the short-term portfolio uses that money to hedge for the long-term portfolio to stop it from losing money if the market goes down. So we turned that into a proper play, and we sold 10 of the 2027 150 puts. So in other words, the LTP gives the STP $23,000. Then it sells the 2027 150 puts for $31,000, so it nets $8,000. Right? The long-term portfolio gives the short-term portfolio $23,000. Then it sells the 150 puts for $31,000. So for the long-term portfolio, it actually picked up $8,000. It's got the $31,500 charge, but that's fine. That's just something it carries on. It's an unrealized loss. But the only cash that moved was 23.2 went out of the long-term portfolio, and 31.5 came back to the long-term portfolio, and the rest is just margin that it's holding. And then it bought 20 of the 120 calls and sold 15 of the 170 calls. And when this thing bounces, if it ever bounces, we will then sell short-term calls to make an income. Nike, we're waiting for earnings. Trox just keeps going down, and we rolled to a larger amount. We rolled these puts to 50 of the December 10 puts. It's still going down, so we'll see if this ever stops. Here's Best Buy. They're plowing ahead, so we didn't have any adjustments to make there. Here's CEPR, which is a copper ETF, and that's doing very well. And what do we do there? Oh, we locked in the gain. So we have this fantastic gain. Well, really for the year from 25 to 30 is very nice. So we had a 20% move in the stock. So we know that's going to pull back. We locked in the gain by selling the July 29s right here for $2. So what does that do? Well, first of all, we're 29.27. We sell these calls for $2. That means we're letting ourselves get called away at 31. Which is great. And so now we have a cushion to the downside. We get called away at 31 if it goes up, and of course we can still roll them. Just because they hit 31 doesn't mean we can't roll them higher. And we put 2,000 in our pocket right now, which lowers our basis on the trade. You can't be greedy. That's really the most important thing. Don't be greedy. See this? You know, it's 32. I mean, not that we held it then, but I'm saying if you have it and it hits 32, take a profit, sell the freaking sell the $32 calls for a couple of bucks. You're getting a big move up that you're locking in right now, but if it drops, and where's 27? Oh, well, from 32 to be 30, sorry, from 32 to 30. So if it drops back from 32 to 30, you already sold the $2, you're fine. And then you can sell 2 more if it looks like it's still weak, and then you can sell 2 more. But don't just sit there and think just because your stock went up, it should keep going up. When the stock moves up 20%, you have to pretty much assume it's going to pull back. 20% is a big move. Even Facebook just broke its winning streak at 20%. Here, then don't forget, these are all short puts, and we're turning them into plays if they become favorable. So Skechers took a dive. on an earnings beat. It wasn't good enough. Their guidance was not enthusiastic, but we're fine with it. And so here we actually rolled down. We kept it in the short-term portfolio. We didn't move it to the long-term. I said this trade is in the STP because it moves violently. This is violent, right? Constantly up and down. It's like a butterfly play. And it moves violently, and we're happy to add more and turn it into like an income-producing play for the STP, because the STP likes to have money. And that was it. That's the whole portfolio. Now we're into the two main hedges. And so we have SQQ, and I said it's just too cheap to roll the 30 calls up to the 40. So in other words, we have the short 30s. La-di-da-di-da. Man, I've got to learn where the page up and page down is on this freaking thing. Here we go. So here's the, so we've got the short 30s. We have 300 short 30s. We already did do this row, but we have 300 short 30s left, and SQQ's at 26.59. So I'm sure I mentioned it here. Yeah, so you take, we're always looking to protect against a 20% drop, because why? Because 10% should be a circuit breaker on the indexes. So if they drop 10%, they should close the market. That means there's almost no circumstances in which we don't have time to react to a 10% drop in the market. Now, a 20% drop means they trip the circuit breakers, and then it does it again and trips the circuit breakers again. That's not too likely to happen in a short amount of time, in a day or two. But those of us who remember 9/11, yes, it did happen. Not only did it happen, but they closed the frickin' markets. Well, they closed it. The markets lost power during 9/11. They were closed for like 3 days, and when they reopened, they were a lot lower than 10%. So we didn't have time to react. But so I like to have a 20% hedge on. So a 20% hedge makes me I figure I can recover from that. And we just did the other day, I did an example of what happens if you have a 40% drop. It's still okay, really, with a 40% drop. So, and by the way, if there's a 60% drop in one day, the world is pretty screwed. So it's not the biggest deal if your portfolio loses money. You worry about your family at that point. A 20% drop in the SQQ would be a 60% pop. In QQQ would be a 60% pop for SQQ. So all you do is take the number and multiply it by 1.6, and that's 42.54. So now we know that 42.54 is our target for a 20% drop. We sold the short $30 calls, and we sold the short $40 calls. So the $40 calls are within where we expect to be on a 40%, on a 20% drop in the market. Therefore, if we roll the other 30s up to the 40s, we're going to gain $10 worth of protection for how much? For 52.5. So if we roll 300 shares up for $52,000, $10, then we bought $300,000 worth of additional protection for 52.5. More protection there, blah blah blah, and now to make that money back, we're going to sell 200 March 27 calls for at 155, and we're at 27, so we're selling at the money calls, but we're only selling 200 out of 600 long, so it's 1/3 cover, and we have 2 years to roll, so I feel good about that, and that means that we overall net $788,000 worth of downside protection. I say here, I'm willing to spend $52,000 to buy 300,000 more protection because I know that I can make the money back selling short-term calls. That's part of the factor of why I'm making this decision. I'm like, okay, it costs $52,000 to do it, and I look over at the March calls and say, well, I can sell $31,000 worth of March calls because now I have this wide spread that's from 10 to 40. So I have a $30 spread, 600 $30 spreads. That's $1.8 million of total protection. So this 31,000 is not likely to kill me. Even if it doubles, it's not going to kill me. So if it starts going up, I'll start pulling some of these back or stopping them or whatever. But meanwhile, I'll end up paying back $31,000 or $61,000 against my long gains, which will be hundreds of thousands of dollars. And by the way, and we know for an absolute fact that this $31,000 of premium will go to zero. See, the stock can go up, the stock can go to 30, and the intrinsic value of the calls will be $3, but the premium will be zero. So that's my advantage. This will go to zero in the middle of March, which is only a month away. So in 1 month from now, this 31,000 will be zero, no matter which way SQQ goes. And that means that if I roll it to a longer month and a longer month, I get to sell more premium. Again, no matter which way SQQ goes, I get to sell more premium. So I'll get my 52,000 back, but my bet is against the intrinsic value of the March 27th. But since it's a 1/3 sale, even if I get totally screwed on those, I still have 2/3 of my hedge making money all the way up to 40 bucks. Okay, TZA. So now it's TZA, and I said I feel better buying back 500 short Jan 25 calls for 37.5. Why? Because it's too close to the money. Well, so here, TZA is at 12, and it could pop up to 1948, and we have 500 short January 25 calls at 37.5. I'd rather buy them back because, again, it clears a slot for me to sell short-term calls. So here we have $928,000 worth of downside protection, and that brings our downside protection to $1.7 million. So all we did was spend $59,000, and now we have $1.7 million downside protection. And well, we're bound the market's coming back, but we were immediately reminded this morning of why that's a good idea. So those are our hedges in the short-term portfolio. We have 15 minutes until the Fed. Here's a $700 a month portfolio. And again, it is just full of good trades. And even if you are only starting now, we're at 39,542. And it's funny because I say this every month. Oh no, I'm sorry, we're not at 39 because we wait a minute. Oh yes, we are. Sorry. We're at 39,542. So we're just under 40,000 total dollars. We've only got 5,700 on the sidelines here in cash. So we're not jumping onto new positions at the moment. We want to let these play out. But how are they playing out? Well, we gained what did I say? We did this review last week. We only made one change. Oh, I didn't talk about it here. That's why. Anyway, so we're up a couple of $1,000s for the month. So, you know, every month we're gaining a couple of $1,000s now. We're adding our $700 each month from our savings. And that's the way we build this portfolio. This is month 30, as far as I remember. Yeah, this is month 30. And at the pace that we're at now, making 38.4% a year in 9 years from now. So taking this 39,542 this is from a couple of weeks ago. Whoop. So taking this 39,542, adding 8,400 a year, $700 a month, in 9 years at the current rate of return, which is highly unlikely to continue, but at this pace, we will have $1.27 million in 9 years, 9 years from today. And I say this all the time because when we started, it was going to take us 30 years, and now it's down to 9 years. And I don't see how it can do much better than that because it's an incredible rate of return that we're getting so far. So I didn't re-review the portfolio, but that portfolio can be seen here. And it's nothing but good small trades. It's a whole bunch of good small trades that don't require margins. And as a group, though, they're very, very well diversified. We have Valet, so minerals. We have travel. We have also minerals, industrial metal. We have SoFi Financial. We have Blackstone Mortgage. We have Stellantis, the car company. Walgreens. We have AT&T. We have our own hedge in this portfolio. We have Paramount, which is obviously communications, or entertainment. Nokia is communications. Levi is jeans. HP Enterprises is computer services. And Ford is another car company. And Northern Dynasty is a gold company. So it's very, very diversified. They're very conservative plays, but we pick them at the right time. That's all. We just pick up bargains when they're bargains. We wait, and we don't jump on something immediately when it goes down. We watch it, we wait, we see if it gets cheaper, and when it gets stupidly cheap, we put it in our portfolio. It's not a complicated plan, frankly. It's actually pretty easy. All right, and here's a money talk portfolio. We also reviewed that recently, so I didn't get heavily into that, but also just great play after great plays. IMAX already up 80%. AT&T short puts already up 80%. This is sad. If they're up 80%, it means that we don't get to make a play out of it. I like it better when they go down, and then we can make a play out of it. But they went straight up, so we just get to keep the money. The money, though, is $7,000. So I mean, just these two positions, we picked up $7,000 of cash, and we don't get to own the stock, but we do get to keep the money. Here we have Barclays well ahead. Here we have Barrick Gold, and on the whole, it's ahead. It's still is great for a new play and home. I mean, I just find it hilarious that Barrick Gold is so low. It's just a crazy number. I mean, somebody's going to figure this out at some point. Because gold's like $3,000, and Barrick Gold is ridiculously low. IVZ is doing good. They're on track. Lockheed Martin has had a tough time. It actually is our biggest loss in this portfolio at the moment. But they'll come back. In fact, we're definitely going to add to this trade when we get around to it. Here's Nokia once again, and obviously doing just as well as the other portfolio. Pfizer, notice Pfizer is basically around even, probably net even, a bit of a loss here. I love Pfizer long term. It's one you can certainly pick up. And here's the key to this. So we're treating Pfizer like a butterfly play, right? We weren't expecting it to go anywhere. It's a 2027 spread. Pfizer's at 25.66, so it's mostly in the money. Okay? It's got 20 longs and 15 shorts, so it's 5 uncovered. We have the 32 puts short, which are aggressive, but I'm happy with it. I'm happy with the target, and 32 minus 6 we sold it for is 26. So our real target is 26. Anything above 26 is just a bonus for us. The net of the spread, however, is what? 13.5 minus 10.7. So let's call that 13 minus 7 is 6. So it's a $6,000 spread, right? The original spread that we laid out was $6,000 net dollars. And against that, in December, we sold the April 26, 27 puts and calls. Look where it is. It's at 26. Anything between 26 and 27, we collect on both of these. Oh, I'm sorry, it's a 27 puts. So our ideal, though, would be to be in the center. So we are basically heading for the center. And what did we sell? We sold basically $3,000 worth of puts and calls against our $6,000 spread. So in one quarter, we paid ourselves 33% in dividends. That's what we're in this play for. And it doesn't matter whether here's our main spread, right? We don't really care whether this is up and down or sideways. What we care about is that we're making this money, because we have 6,000 invested in this group and we're already up 1,000. And we're on track to make $2,000 to $3,000 if we can get in the middle of this somewhere. And by the way, so since we sold the 26 calls and the 27 puts, we lose 50 cents on both sides in the middle. So we're going to lose $1 anywhere between 26 and 27. So we can't do better than $1. I'm sorry, we can't do better than $2, $2,000 on this or around that, because we picked the middle. But that's because we don't care what this is either. What we're going to do is roll the losing sides and widen the spread. But all that matters is me saying, geez, if we picked up this long spread for $6,000 and we're selling, and we can make 2,000, not 3, we sold 3. If we can make $2,000 each quarter for 8 quarters, that's $16,000. That means we're going to have a massive profit over our $6,000 spread, and whatever amount our $6,000 spread is in the money is just bonus. That's the power of the butterfly portfolio plays. There's so many ways that you can win. And the thing about it is, and this is why it becomes so powerful later on, it's not that exciting. We're only from August, so we're about 6 months into it right now. At 6 months, we're up 14-something%. That doesn't sound very thrilling, but that's how it always starts out, because these are simple conservative trades. We're only using $30,000 of actual cash to match for these spreads so far. So we haven't bought a lot of trades for the butterfly. I'm sorry, it's not the butterfly, it's the money talk, isn't it? Which one is this? Yeah, I'm sorry, that's a money talk portfolio. So we've only deployed a small amount of money into this portfolio, but the power as it goes on is that, I mean, think about it. So we're making $2,000 a month. I'm sorry, $2,000 a quarter on a $6,000 spread. So what happens? The first 3 quarters are spent paying off the spread, but now we have a free spread and we're still making $2,000 a quarter. And then what do we do with the $6,000 we got back? We buy another spread. So now we have 2 spreads that are making $2,000 a quarter. And then in 3 months, that one gets paid off. Then we have 3 spreads that are making $2,000 a quarter. So now from our original $6,000, after 9 months, we're making $6,000 a month from our original $6,000. And we have, and it's not even that though, because now that we have another set coming in, we're going to be making $8,000 a month from our original $6,000, and we're going to make $10,000 a month from our original $6,000. And that's why the butterfly portfolio, I'm sorry, this is a money talk portfolio, but it's a butterfly play. That's why this kind of portfolio though, when you let it roll for a few years and you go into the next cycle, you're just getting free money all over the place. It's just pouring in. You're just constantly selling premium. It's like a dividend play on steroids. And that is the way to play the market. Then you've got Synchrony Financial, which is a basic play and doing fine. It's basically on track. It's another thing you have to realize. We're at 65. So we're $15 in, $22,500 in the money, yet, right? So we're right on track. It's doing exactly what we want. We're $22,500 in the money, but the net of the spread is 33. What the hell? It's 33,225 minus 16,725 minus $9,700. The net of the spread is $6,800, but we're $22,500 in the money, and we will be. It's a $30,000 spread, so this spread can go $30,000, and you can buy it right now for $6,800, even though SYF is at 65. It's above the put line. It only has to get $5 up to make the call money in the next 2 years, and you'll end up with $30,000 minus $30,000 divided by, I forgot the number. Frick, 6,800, right? So it's going to make 341% in 2 years if Synchrony is over 70. This is our trade of the year, by the way. So if you say, oh, how's your trade of the year doing? Well, not well, it's minus 33, 35, it's barely up a few $100. But this spread is exactly on track to make a massive amount of money, which is exactly what we expected it to do. The whole idea of a trade of the year is, how are we sure? It's a trade that can make at least 300% that we have the highest degree of confidence in. And we picked it in November at Thanksgiving, and it hasn't gone anywhere yet. We're right on track. Why? Because we didn't pick a high target. We were at 65 in November, and we said we think it'll go to 70 in 2 years. We weren't being ambitious, but because of the way we laid this trade out, because of the way we laid the trade out, we are making money on premium decay alone. But that is, as boring as it looks, that's a phenomenal trade. That trade's going to make 300 and whatever percent. How much? 341%. Here's Target. Also very boring. Target's at 130. And we have a 120, 150 spread. So we're $10,000 in the money. We're well above the put target. And this spread says 27,525. What the hell? 27,525 minus 5,388. What? 5,388 minus 15,500. And this is also $6,600. And the spread is, like I said, we're 10,000 in the money, and it's a $30,000 spread. So it's another 300% spread. If Target can get to 150, it's already at 130. And here's Exxon, and Exxon is a $20,000 spread, and it's 13 minus 12, so it's net $1,000. So this one's going to make, 1,000 plus percent. It's going to go up more than 10 times. And all Exxon has to do is get to 130. It's only at 108. So we're looking for a little bit more upside here, but it's only $1,000 to take the risk. I mean, what's your risk? Your risk is owning Exxon. But if you don't mind owning Exxon at 110, it's not much of a risk here, right? You own, your worst case scenario is you own 500 shares of Exxon for $110. But if it goes well, you're gonna make 20,000 bucks on the spread. That's the portfolio. Boom. It's not that hard. Anyway, so you guys can look up the rest. Let's take a look at what the Fed's up to. So should be some minutes. There they are. The minutes. It's a lot of minutes. Voting for action. That's where we can do it. Okay, Control C. I don't think anything below this is relevant. Nope, it's not. And this will be a pleasure because Warren's ready. Here's the January minutes. Let's start with a summary of what they say with comparisons to the prior minutes thrown in well. You had to think about that for like a good 10 seconds. I love AIs. See if there's any questions in chat. Jean-Philippe said, suggestion for educational post, something about the process of choosing the right options to create a spread for covered calls, etc. Okay, can you ask me that in chat so I remember? The market, I don't have a note thing here. When I close the webinar, it all goes away. All right, so where are we? Ma-dee-dum. Okay. So January Fed cut, the January Fed minutes reflect a cautious but measured stance, reinforcing the notion the Fed will not rush to cut rates and inflation remains a concern. While there are no dissenting votes against holding rates, the tone suggests policy will remain restrictive for longer, particularly given emerging inflation risk from tariffs and continued labor market resilience. Here's a detailed breakdown of the meeting and the minutes along with what the Fed signals. So, monetary policy and rate cut. What changed? The December minutes hinted at potential cuts in 2025. The market was expecting 75. By January, the Fed reinforced its wait and see approach, indicating they are not yet convinced inflation is on a sustained path towards 2%. Now, since then, of course, there's been evidence that it's not. That's important. The Fed acknowledged recent disinflation progress, but the pace of the rate cuts was called into questions. Rate cut expectations are being pushed out. In December minutes, possible first cut by March, May. In the January minutes, there was no rush to cut rates. So they were already leaning that way at the January meeting, plus the data went very much against cutting rates. And just for reflection, the NASDAQ at this very moment is at +2, the S&P is +3, and the Dow is -133. All right, so that's where we are at the release of the minutes. So by the January meeting, they were already suggesting that we could be 50 points or lower. Policy restrictive, a careful approach was emphasized, meaning the Fed will only cut if they are fully convinced inflation is contained. In December, the Fed showed some willingness to consider rate cuts, but still cautious. January, the Fed reinforced a more hawkish stance, highlighting ongoing risks for inflation. Inflation and pricing pressures. In December, the Fed acknowledged inflation had eased but wanted more confirmation. They didn't get it. By January, inflation progress has slowed. Upside risks emerging from trade and fiscal policy uncertainty. And don't forget these tariffs. If they do it, it's guaranteed. It's guaranteed inflation if they do tariffs. And not a little, a lot. Participants cited the risk that local tariffs could, oh no, there it is right there. Market-based measures. That's because it's a fact, It's like, when you ask a bunch of scientists and economists are should be scientists anyway. They often aren't, but they should be. But when you ask a bunch of scientists what's going to happen if if the temperature goes to 32, they're all going to say, well, water's going to freeze, because that's what happens at 32 degrees. This is how it is for economists looking at tariffs. And you say, well, what's going to happen if they have tariffs? Inflation's going to go up. It's not a maybe. You don't go with your gut on this one. It's like, this is what happens when you do tariffs. You will drive inflation higher. Market-based measures of expected inflation have ticked up, suggesting the Fed sees less progress on inflation than before. The Fed sees inflation risk skewed to the upside. In December, they had more confidence in disinflation. In January, they have concerns about inflation stalling. Service inflation remains sticky. Housing and labor costs are not easing as quickly as expected. The Fed increasingly skeptical of market optimism. So the Fed's looking at the market and being like, what is wrong with these people? Markets expect rapid cuts. The Fed is not aligned with that view. Comparison December, still cautious but expecting gradual inflation decline. January, more concerned that inflation is uneven. Labor market and wages, what changed? The labor market remains strong with continued job gains and low unemployment. The Fed noted the job market was cooling, but no major deterioration. So they thought it was cooling, but it didn't. And now the Fed no longer sees that. The Fed no longer sees the labor market as a source of inflationary pressure, but wage growth remains moderate. So in other words, they're saying, okay, so they're not hiring more people per se, but they are, but wages are growing quickly, which is interesting, but we just had a good jobs report, so that's not really true. The firms are hesitant to cut jobs, which could keep inflation higher for longer. In other words, having spent the second half of last year struggling very, very hard to find good candidates because there is a general labor shortage, firms are not cutting people like they would normally when things slow down because they're terrified of having to go, when things come back, if it's a short-term slowdown and they have to go back and look for people to hire, they're worried that they're going to spend all this time and effort and whatever, and the salaries keep going up. So they want to keep the people they have. That's a problem in a recessionary market because you're not going to get a quick adjustment, and that's going to put more pressure on the government to do things. And now we've got a government that refuses to do stuff, so it doesn't get better. Labor market stabilizing, not weakening. The Fed sees no urgent reason to cut rates. Some wage pressures are easing, but not enough. Low-income households are struggling. Overall employment is strong. The very mixed bag, and none of it's good. It's like all these different pieces, but they're all going the wrong way for themselves. Gradual labor softening, not alarming. Labor market holding up better than expected, less urgency on rate cuts. So what changed in financial conditions? In December, the Fed noted that financial conditions had eased, so the markets were acting as if rate cuts were coming. The Fed acknowledged that financial conditions were still loose. They did not push back aggressively. Equity prices were little changed, and the Treasury yield curve remained relatively stable. And the Fed, by the way, did all this because when they cut the first cut a half a point, everybody started assuming they were on this incredibly aggressive rate cutting thing. If you're going to start with a half a point, you're like, hey, you ain't seen nothing yet, right? You're expecting like some big cuts coming to follow. They didn't do that, and that screwed everybody up. So expectations went way too low as far as where the targets were for rates, and now the Fed went the exact opposite way and said, well, I was just we only cut 2 times. We didn't want to get everyone all excited. The financial markets still expect cuts sooner than the Fed does. The Fed remains cautious. The markets are underestimating how long rates will be this high. Comparison to December. In December, the markets were pricing in more cuts than the Fed expected. In January, the markets are still too optimistic, and the Fed is not fighting that view aggressively. That's an interesting thing that may or may not change. How are we doing? 30-year fixed, 15-year fixed, Dow's down 118, Bitcoin 95,000. S&P is up 4 points, so this is nothing bad. It's a wishy-washy reaction, but that's good. That's good. Let the market absorb it and understand the conditions that we're in. Balance sheet and liquidity concerns. The Fed continued reducing its balance sheet, but flagged the potential concerns over how the debt ceiling will impact revenues. The January minutes suggested the Fed might pause their balance sheet runoff. That's interesting if liquidity becomes a concern. That's dovish. The Fed is still unwinding its balance sheet, but could adjust if necessary. Market liquidity is sufficient, but long-term effects are uncertain. Debt ceiling concerns trigger a thing. We still haven't resolved that yet. Comparison to December, balance sheet reductions to continue. January acknowledgement of liquidity. Trade policy. In December, the Fed was not concerned about global risks. Ooh, sorry, what is that? Well, that's weird. This black thing here. I thought it was a scratch on my screen. Fed wasn't concerned about global risks. In January, they're acknowledging that China's slowdown in trade policy. This is before the recent property problem. So this is the Fed just looking at China and going, this is bad. The Fed is now factoring the impact of tariffs on inflation. China's economic slowdown is becoming a concern. Tariffs are a new inflationary risk that could delay cuts. The Fed sees geopolitical risks rising. Global risks weren't a major policy factor. Trade risks in China and China concerns are now on the Fed's radar. What this means for Fed policy. Rate cut timeline. So December, cuts in March and May, and now we're talking May and June. Impact hawkish, interesting. Total cut 75, 50 or less, more cautious. Inflation outlook, a gradual decline expected. Risks of stalling are now there, and delaying Fed cuts. Labor market softening but not weak, holding up better than expected, supports the higher rates. Financial conditions too loose, no action. Still easy, but the Fed is watching. It's mildly hawkish. Balance sheet, continued reduction, could pause with liquidity. That's, like I said, it's a dovish thing for the Fed to say. Global risks are not a major issue. China tariffs are now a concern. Potential market volatility. Final takeaways. March cuts off the table. The Fed needs more confirmation. The market should expect a longer wait. Tariff risks add a new inflationary threat. Trade policy could delay cuts even further. China's slowdown is now on the radar. And don't forget, we got hugely bad China news after the Fed meeting. If China worsens, and it did, the Fed might cut rates even later. Markets remain too optimistic. The Fed sees higher for longer rates in the base case. Traders are expecting cuts that aren't going to come. What to watch next? February CPI and PPI, Fed speeches, which are coming up, and we have a bunch of them this week. And China's policy, anything that goes on in China, we got to watch, and market volatility. So there you go. And let's see if we can give this to the guys in chat. Oh, that's not today's post. You know, somebody said I was too hard on Trump today, and I didn't even feel like I said anything bad about him. Let's take a look. I said tariffs on. Trump's trade policies dominate the headlines. The impact of tariffs, and that's based on the fact that Americans are going to pay more taxes. Speaking of which, co-president Musk happens to make 900,000 cars, and he's the one that's not, he's benefiting from all these tariffs. Just a coincidence. Someone said it's just a coincidence. I'm blaming Trump, right? Let's see, did I say that? That's a coincidence. See, what an amazing coincidence. I knew it. I knew I didn't blame Trump. Speaking of Trump, he blamed the Ukraine for the war that started when Putin launched a full-scale invasion 3 years ago. You should have never started it. You could have made a deal, Trump said of Zelensky. I'm just quoting the frickin' newspaper, who was not even invited to please talk. Putin, blah, blah, blah. Trump said Ukraine should hold elections before the deal can be reached, saying without any basis, and again, I'm quoting the newspaper, that Zelensky had no support and that his approval rating had fallen to 4%. That's, of course, complete nonsense. But, you know, I mean, it's an obvious lie, but I didn't say it was a lie. I'm just quoting what Trump said. European leaders who are our allies were excluded from the peace talks in Europe of the European war, and they were stunned by Trump's Chamberlain Act. That's just a historical fact. This is what Neville Chamberlain did in World War II, appeasing Hitler, who I'm comparing to Putin, not Trump, right? See, I'm being very respectful of the president. And any world leader has been taught not to do that since 1939. Zelensky said Trump was repeating Russian propaganda points. He is, but we're only quoting Zelensky. Unfortunately, blah, blah, blah. I want there to be more truth on Trump's team. A fresh poll by Kiev shows that Trump was completely lying, and Zelensky's approval is 57%, which is up 5% from December, not 5% total, up 5%. You know, we saw this disinformation. We know it's coming from Russia. It goes straight through the president's, from his ears to his mouth, right out there. And you know, this is his fucking living room. I mean, he's standing there in his living room with his little podium. But I didn't say that. And Zelensky just said, it's like we know that these are, we know this is all bullshit. Here's the land that Russia now occupies, which is shrinking. They're losing. They were all the way around on the top and everything, and Ukraine has driven them back. See, that's where they were, where it started. See that? So at the beginning, they were all up here in the war, and the Ukraine is driving them back and back. It's steady progress, and Russia is losing. So now they are bringing Trump to the peace table, not Zelensky, Trump. Trump said Zelensky gave Ukraine 350 billion, and it was actually 67 and 31, and there are receipts. So, total bullshit, whatever. But I didn't say it was bullshit. I just quoted what it was. Zelensky pushed back at Trump's claims that he gave the Ukraine this, and it was really this. I mean, I don't know. It's a fact. And then Trump asked Trump was trying to get Zelensky to sign over the Ukraine's natural resources, and Zelensky said that's not a serious conversation. I'm not going to sell out my state and my people to you. And that was, again, it was him and not me. I didn't say it. And I said, at least we don't have to worry about the bird flu, as the Department of Health and Human Services have laid off thousands of people. They just sent out emails based on God knows what criteria. They certainly didn't speak to anybody in any of these departments. And obviously, from the way the layoffs went, they were indiscriminate. They just randomly cut people who were department heads. There could people in, you can leave it, if you leave a team, but you get rid of the people who run the team, what are the people in the team supposed to do? So stuff is just grinding to a halt. Now, all right, maybe I did something here. Let's see if I did something bad here. Here is currently our bird flu infections. Now, if you guys remember, not 5 years ago, whenever Trump was president last, 8 years ago, 7 years ago, Trump had a COVID map, and there were only 5 or 6 cases of COVID in the US. And Trump said, it's nothing to worry about. And he said there's no reason to do anything with just this many cases. It was less cases than we have of bird flu. And these are humans having bird flu. Birds having bird flu, hundreds of millions. Okay? It's starting to spread to humans. It's starting to evolve and spread to humans. So all I'm pointing out for the human beings on this planet who might be concerned is that, we didn't take COVID seriously and we paid the consequences. And now we're not taking bird flu seriously. So at the same time that Trump is laying off all these people, and I didn't make this connection here, employees of the CDC and the Food and Drug and the National Health Centers and the Medicaid and Medicare services began receiving emails Friday stating they had been terminated. That's a fact. The messages said blah, blah, blah. That's a fact. And I said, as a reminder, the above is Trump staring at an early COVID map as it began to spread. And I said, thank goodness he's in office again, not negative. As we face another pandemic, right? See, I'm just seeking agreement among my Republican friends that we're thrilled that Donald Trump is overseeing another pandemic. This is going to be great. Only 1.1 million Americans died of COVID. That was 10 times the rate of any other country in the world. So we beat them all. We had 10 times more people per capita die in the US than third world countries of COVID. And I said, but of course at the time we had a functioning Health and Human Services, it's now been gutted and will be much less effective. And Trump has been, I think he actually did sue Fauci. Did that happen? Hang on, let's find out. Trump, oh no, because Biden punished him, right? Trump sues FAUC. Fauci? Trump trashes Fauci, makes baseless coronavirus accusations. Da, 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 da. He sues Stephanopoulos. Sues the Des Moines Register. Okay, he didn't sue Fauci. I think Biden preemptively pardoned Fauci so Trump could not sue him. But you see, the fact that he did sue him means that the threat is there for anybody who would dare to speak out against his policies. That's fine. And I didn't say it here in the article. It just happens to be a fact. The abruptness of indiscriminate nature of the firings caused confusion and chaos. Even agency leadership was uncertain as to who was affected by the cuts, how teams will function. The administration's actions to swiftly dismantle the health infrastructure cannot simply be put back together again. Well, of course not. You got to hire highly trained people. And if you kick out the ones who came up through the bureaucracy, the people coming in have to learn how to function within the bureaucracy, plus learn about the strengths and weaknesses of the team and so on and so forth. And God forbid somebody would put less qualified people in there, then you might miss critical things that lead to millions of people losing their lives. That's all. But I didn't say anything bad about Trump here. The CDC was the first to feel the squeeze. The epidemiology's intelligence service, which right now we know we're heading into another pandemic crisis, and we fire the crisis team that handles the stuff. But again, not saying anything bad about it. Just draw your own conclusions. Cuts at the FDA began on Saturday. 89 staffers in the food division. Jim Jones, the deputy commissioner, resigned. The person who heads Medicare resigned also because they say it's a complete disaster and they won't oversee it. Jones's resignation letter said the players include people with highly technical expertise in nutrition, infant formula. Remember, we had the whole infant formula problem a while ago. They got rid of all those people who caught that thing. Food safety. So next time we have an outbreak of listeria or whatever, it'll be like, nobody's going to know who's in charge. FDA, and I didn't say any of that. It's just, conclusions. The FDA lost a substantial amount of staff who view medical devices. And this is a constant thing because, if you have any kind of things, if you're giving blood, diabetes, all that stuff, there's a lot of monitoring that has to go on for all these devices and the needles and the drugs and so on and so forth. It's just as important. When you say Food and Drug Administration, they monitor the food and they monitor the drugs. So in 2024, 22% of the recalls from the FDA were listeria. So undeclared allergens, that's just when they forget to put label peanuts may contain nuts on the box, things like that. I can understand where you might have a problem with that you do a whole recall over something like that, but is what it is. But these are what I care about. 22% listeria, 13% salmonella. Excessive lead is extremely, extremely horrifying. E. coli, horrifying. Things just not inspected at all. You would think that wouldn't happen, but 3.4% is because things just don't get inspected. Things that are not eligible for import. So this is what the Food and Drug Administration, the USDA, is supposed to be protecting us from. CMS, which oversees Medicare and Medicaid, were also infected. This makes sure that consumers aren't overpaying for their health care. We know there's a lot of that kind of fraud going on. Politico reported that 80 people were cut from the center that implements the Affordable Care Act. So in other words, they can't repeal the Affordable Care Act, but they can certainly stop it from working. So it's like, yeah, sure, you still have an Affordable Care Act, but we're not going to let you, we're going to gut it so that it doesn't function. And then people will start complaining about it and we'll say how bad it is. This is a good quote. It's not just the individual feeling of uncertainty, it's a hostile workplace all of a sudden because you look at your computer and you don't know who is behind the next email you're going to get. So in other words, fear and paranoia and so on and so forth in an agency that employs people who are basically scientists who are supposed to be working on our behalf and curing things and not worrying about whether or not they're going to have a paycheck next week. You know, when you distract people, they tend to not do their jobs as well. That's kind of a fact. It's not an environment that fosters a breakthrough in cancer discoveries. These cuts have shaken the foundation of science and health in the U.S. You know, I'm not saying anything bad about Trump. I don't understand how I get complaints. Could not be more respectful of the president, considering what I really think about him. I mean, I'm almost kissing his ass compared to how I feel. Anyway, so the housing market index is collapsing. If we had a fresh copy of this, it would be 1.36. It's down here. It fell from here to here, and here is where we were during COVID. It was pretty freaking bad. I said, fortunately, we upped our hedges in the short-term portfolio, as we just noted. We're reviewing the long-term portfolio, and so I'm sorry. You tell me. I mean, I'll take the criticism. If you think I was being hard on Trump in this thing, let me know. I don't know what else I can do. I don't know how much further I can go in pretending that this is okay. Let's see. Oh yeah, what were we gonna do? Oh, we were gonna put the. I was gonna put Warren's thing in. I forgot about that. Got distracted because somebody told me I was too mean to Donald Trump. And I really don't see it. What a pleasure. He does his own formatting. I don't have to worry about stuff. Woof, it's a lot of stuff. La 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 da 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 da. Now that's the thing doesn't come out right, unfortunately. It doesn't hold the formatting. The WordPress problem. Oh, what's all that? Well, let's see what happens. Think all these emojis are gonna work? Nope. Oh well, still pretty good. All right, so that's where we are there, and we can go back to now we can some serious analysis on the butterfly portfolio. So, you know, always remember when we do these portfolio reviews, wow, 556, okay, that's a lot. Because it's only for members. It's pretty full attendance on that. Let's see. All right, so, you know, we bumped up our protection. And we feel like we're in pretty good shape. We talked about the $700 a month. We talked about the money talk, and now the butterfly portfolio. So, like I was saying, you've always got to keep in mind that when you look at these portfolios, a lot of them are just brand new, can be brand new trades. So here's BHP and BP, and you can see, by the way, we already made a ton of money. Okay, so you can skip that, right? That's not going to be great. Apple also made huge amounts of money. Well, you have to look at the whole trade. I mean, this is a whole Apple trade. It's two sections. So it's basically like two different trades. That's one group, that's another group. And we probably added them at different times slightly. But it's the same thing. And then we've got the, if we're making adjustments down here, you got to look at it and say, it could be good for a new trade or whatever. Here's Caterpillar. We just added Caterpillar. So that one, and you can see, yeah, it made a bit of money, so it's already kind of taken off. Here's Cisco. Cisco's negative. That means, oh, no, it's not negative. 21 minus, well, it's not up that much. So Cisco's still good for a new trade. Delta. Whoa, Delta made way too much money. Oh, it's blown past our targets. That's why. Oof, that made a lot of money. Disney. I was gonna say the new trades. Disney is also gained, but wow, no wonder the butterfly portfolio is up so much. Dow, here you go. Look at Dow. Dow's not up that much, or it's not up at all. Actually, it's negative. It's plus 12, plus 11 or 12, minus 13, 17. There you go. See, Dow's not even profitable. And again, what is the trade? So you're saying, well, Dow's at 40, and we have the 40 call, so we're low in the channel. We sold the 52.50 puts. We sold the 57.50 calls. Might be a little aggressive at the moment, but still, what's the net? The net is 15. Wait. I'm sorry. The net is 14 minus 15, so it's $1,000 credit. 2,000, so it's a $3,000 credit on the spread. And you don't have to be so aggressive on the puts. If you're going to add it as a new trade, just take lower puts. It'll cost a few more, but no big deal. And then we sold against that though. So we have a $2,000 credit trade over here, right? And against the $2,000 credit trade, we sold, and it still is, wow, $9,000. Originally we sold $7,500. We sold $7,500 worth of puts and calls. So if you were going to do this from scratch, all you do is adjust it and do the $40 puts and calls. And what happened in Dow? Let's take a look. Let's see what went wrong with these guys. Oh yeah, so earnings were bad. How bad were they? Really bad. They had a huge miss here. They had a huge miss here, and this miss is meaningless. It's 1%. So the thing is, the earnings miss was really bad. Okay, but still, they were already pricing in bad earnings. They had good earnings here, and they went down because their guidance said they're not going to be good next quarter. Now here we are next quarter, and they said, yeah, see, we told you, bad. And the people who saw these earnings traded it down. The next day it went down some more, but then it starts recovering because everybody already knows they were going to be bad. But meanwhile, the stock's only trading at 15 times earnings, and this is probably the low for the cycle. Probably, not necessarily, definitely, but it doesn't matter because we can create a zero cost long trade here, and we can sell $7,000 a month, not a month, $7,000 a quarter against it. So from an income producing standpoint, this has huge profitable potential. And notice that we had, and here's, by the way, here's where we got hurt. We had 30 longs and only 20 shorts. So we had a 10 over covered, but we sold 15 calls against it. But I love this trade. I love this setup. This is going to be a huge income producer. It'll be it, and it doesn't matter if we take a loss here because we're only going to roll it. In fact, let's take a look at that. Oh no, I don't have Thinkorswim up. Okay, but anyway, trust me. If you look at if you go from March and you roll to June, we'll be able to roll these 45 puts down to the 40 puts in June. 40 is where we are. So we'll roll the 45 puts to the 40 puts. We won't roll the short calls because the short calls are expiring worthless. So the loss that we're taking here can easily be reversed if they just hold 40 bucks until June. Meanwhile, we're going to sell more short calls for another couple of $1,000. And we're going to keep doing that for 2 years. And we paid nothing for the spread. Net zero we paid for the spread. All we have to do is nudge these things into expiring worthless, and it's all profit for us. Now here's IBM. IBM is crazy, but here's, oh, and again, this is one of the funny things about it. So the IBM spread is the 210, 270 bull call spread. It's essentially in the money for $700,000, okay? But the net of the spread, what are the puts? The 160 puts. So the net of the spread is 719,250 minus 3,580 for the short puts is the current net of the spread, minus 390 for the short calls. So the net of the spread is 325, but it's a $700,000 spread that's in the money. So we have $400,000 left to gain. If it just holds, if it just gets to 270, we have $300,000 left to gain on this top half of the spread. And then what did we do? We did what we always do. We sold we sold January 230 puts. So we sold more puts apparently. Oh, so that means the net of the spread is minus those other puts too. We double sold the puts. So minus 56,925. 56,925 is 268. So we got a solid $530,000 left to gain. Because it's a $700,000 spread. It's currently 268.75. And if we finish, these puts and these puts expire worthless. Right? Those puts expire worthless. And you know what happened here? IBM went down. And we already had the short puts. We had these short puts from February. IBM went lower, and I was like, screw that, we're selling these. I'm like, if you want to sell me these puts for 30 bucks, I'll take it. So then all we had left was the Aprils. And we sold the April 215 calls. I'm sure we rolled these from something else because we wouldn't have sold 50. And now we sold them for 10 bucks. They're 50 bucks in the money, but they're 50 bucks in the money with a $250,000 loss against what's going to be a $500,000 gain. So we're still going to make a ton of money, just not as much as we would have made. So what are we going to do? We're going to roll these calls to a higher strike and a higher strike and a higher strike, and hopefully it'll work out. And by the way, I don't mind buying more IBM longs, especially when I only have to pay $268 for $700,000. I'll pay another $268 for another $700,000. I got no problem with that. But we're not there yet. Why? We're not worried yet because we still have a year and a half to roll these things. So we'll see what happens. So right now, that's just protection against our massive gains. Here's international paper. This is also at a loss. So if it's at a loss, therefore, it could be good for a new trade. International paper is at 57. That's a little weird. We sold. Okay, these are $10 in the money. I get that. What's our long play? Our long play is 45.60. There you go. And we sold the June 55 calls, which is right where we are. So that's not a problem. But we also sold these April 47 calls, and the same thing. We're going to have to roll these out of trouble. And here's my notes. We're adjusting Dow. We're adjusting IBM. We rolled the April 215s to the June 240s. So I already had a plan for that. Here's Johnson & Johnson, which is also good for a new, oh, no, it's not. Wow. We made too much money there, so not great for a new trade. Here's Coca-Cola. And Coca-Cola, 16 down. Yeah. I mean, it's close. It's playable. We're up about 10,000 bucks on the trade so far. Here's Mattel. Oh no, we made too much money on Mattel. Here's Pepsi. Clearly, well, we only just added Pepsi. So yeah, Pepsi can be added. And what's the deal with Pepsi? 44 minus 33.34. So it's about a $10,000 spread. And against the $10,000 spread, we have $10,000 worth of short puts and calls. Wow. Gotta love that. And that's even after they've made some money. We sold them for $13,000. So they're 10,000 now. We sold them for $13,000. So this spread is net zero. And what we're making we're making $13,000 a quarter selling puts and calls from a net zero trade. And we have, what quarter is this? June. So we have, well, we're not making it per quarter, we're making it per half. So let's say we make $13,000 times 3 going forward from here. So it's a net zero trade, and we have $39,000 of puts and calls to sell in the next 2 years. And it's a, what is that, 25? So 25 times 25 is, 112, no, 12,500. That doesn't sound like enough. 22,500. 2500 times 25. 62,500. I was so off base. So we have $62,500 to gain if we can get to 165. So the potential is there, but we don't really care about that. What we care about is the fact that we can make $40,000 just selling puts and calls. If we make this money, it's a nice bonus, but it really doesn't matter, because all we're going to want to do with this is roll it back 2 years and make another $60,000 in the next 2 years selling puts and calls. Here's our buddy Pfizer, and this one's a loss, so this is better than our original entry. And here the spread. Oh, well, there's two different. Oh, I see. The problem is this is our original spread. We took a big loss on it. So if you take that out, because you obviously don't have to double sell everything. If you take that out, what we have here is the 23.30 spread. That's a $70,000 spread. And against that, we have the $35 puts, and we have the $30 puts over there. You can take it as you wish, and we're selling, and we aren't selling short calls because we think it's going to bounce. Here's Transocean, also about even, so still playable. We took the December, a little risky this one though. We took the 3.7 spread. It's only at 355 because we think that oil prices are going to come up and ocean drilling will come back a bit, but I don't know if it'll come back by December. But when the new trades, oh, I think I already did a roll. Hang on, I'm going to cheat. I'm pretty sure 2027s came out and we are doing this roll. Oh no, we intend to roll when the 2028s come out is what I said. Oh, because it's December 26. It's already in December 26. These are actually further out than I'm thinking. So we got tons of time for this to work itself out. Now, TAN is a solar ETF, and everybody's terrified of solar under Trump, but I love this trade. I made adjustments down below, but this is another one that's good for a new trade. TD Bank is good for a new trade. They were bad boys. They got fined. They're getting better. We're already making a ton of money on them. Valet, we just had a conversation in chat about these, and I said I definitely still like them. I think they're way too beaten down for where they are. We've got Verizon. That again, it's a brand new trade, so it's exactly where it should be. Huge potential money there. Whirlpool, we made so much money on Whirlpool, it's ridiculous, and it actually pulled back a lot. And it again, though, it's just insane amounts of money to be made in that stock. And Exxon is another one we just added, and also about even. So great potential with Exxon, 110, 130. We're at 110. It's not about the 110, 130 spread, which is net 34 minus 25 is about $9,000. So it's about $9,000 net. But what are we doing? We're selling the June 110s for $12,000. So if we happen to hit the nail on the head, and right now we're at 110, we're exactly where we expect to be. If we hit the nail on the head 122 days from now, we're going to make $12,000 on a $9,000 spread in our first half. But then we can make another 12 and another 12 and another 12. That's 36,000 back, and we'll have a zero cost basis. Plus, we get a bonus of up to $50,000 if the spread works out. It's insane. It is really insane how much money you can make with option plays. And these are not the kind of options. It's the opposite of an option play. It's the opposite of what people usually do with options. We're selling all the premium. We're being the house. Other people are paying us to bet on what our stock is going to do, and we're betting we don't care. We're betting that your premium will expire worthless. So give us your premium money. We'll keep that. You have fun with the result of your spread. We're bookies. That's all we're doing here is being bookies, and bookies make money. That's why throughout history you see bookies. In the Roman Colosseum, there were bookies. Jesus did not like bookies. Probably because he lost money. But yeah, when you let people wager and you have a spread, and that's what option premium is. Option premium is a spread. And you get to be your own. The greatest thing in the world about options trading is you get to run your own little bookie operation. And you've got guys who want to bet it's going to be over 112, and you have guys who want to bet it's going to be below 106, and they'll both pay you money. And statistically, 80% of the time, it's neither. It works out somewhere in the middle. 80% of the time, options expire worthless. Almost 90% of the time, actually. Yet you get to take those bets, and it's not like Las Vegas where you like go on the other side of the craps table and you get to be the house or whatever, or be I forget what they call it behind the craps table. Whatever, be the dealer. I guess it's being the dealer. But when you take the opposite side of the craps table, you're theoretically the house, but you're not, because they don't give you the same odds that they get. They're screwing you over on the odds. You're not really being the house, but in options, you are. You get all of the odds because people just don't take that position. And the brokerages don't take that position. The brokerage aren't betting. The brokers take a percentage of bets on both sides. So it's a different game. They're raking money. So it's more like poker, right? Where they always take money off the table. It's like that. The brokers take their money off the table. They don't care what side you're on. The odds are the same for both players. So the totally shitty odds that the players on the gambling side of the table are getting are the totally shitty odds that you're giving them if you become the guy with the money. If you want to be the house and step up and take those bets, you get all the odds. And it comes out in your favor 85% of the time. It's in your favor. And that's what we're teaching at PhilStockWorld. We're teaching you to be the house. And these stunning returns are what you make by being the house, by learning the patience and the discipline and the correct stocks to play and the correct options to take the money on. It's better than being the house, because when you're the house, you have to take all the bets. We don't have to take all the bets. We take the ones we like. We take the ones we think are going to be favorable. We take the ones that are most to our advantage. That's what we're teaching you how to do. And as you can see from the portfolios, the positions, the performance, we can do it over and over again because there's 6,500 stocks trading on the American exchanges, and we pick about 200 of them that we think are ideal for what we want to do. So it's our selection process and the identification of the options and understanding the strategies. But when you get all this stuff down, it's just basically it's a money printing machine. And that's what's great about this stuff. And they're all there every month. You can always find them. They're in our reviews, and you can see what to bet on, and you can see what we like. And obviously we pick a few new ones every month to go into the portfolios. We just pick ones in discussion, and it's always there. We've been doing this for 20 years. It's always there. There's always something that we can trade all the time in any kind of market. All right. Thanks everybody for coming. I appreciate it. And we shall do it again next week. All right. Take care, everybody. Oops. Oh, sorry, Cody. Cody's asking one of my thoughts on using structured notes instead of an inverse ETF. Uh, I mean, structured notes are tricky, and we should talk about it in chat. So if you want to bring it up in chat, we can talk about it more. But it's just, to me, it's easy to have everything in the same portfolio that's actually reacting at the same time. But you can, yeah, if you're sophisticated enough and you've got the legal people and the bank and accountants to go over it, make sure it's all done right, and you're able to run all the sheets and make sure it's you're getting the correct payouts that you're expecting. Yeah, you can do it. I mean, it's a really advanced way to handle it, but it is doable. All right, but I'll be happy to talk about it more in detail in the chat room. Okay. All right, thanks, guys. Have a good week. Have a good weekend. See you next week.